For more now, let's bring in Wharton School professor and Wisdom Tree senior economist Jeremy Siegel. Professor, welcome back. It's nice to see you in this new year.
Good afternoon, Scott.
What do you make of the market's reaction today to that better-than-expected jobs report and the move in rates?
Well, the price in stocks is always a battle between the numerator and the denominator. The numerator is earnings. And the strong, it's a strong report, and that's good for earnings. But it also, strong report also means higher interest rates. That's the denominator. Today, the denominator beat the numerator. I think really the market is saying maybe no rate cuts in 2025, and that the 10-year could very easily break well above 5%. One has to realize, I've done the historical research, over the last half century, the long rate has been on average between 1 and 1.5 percentage points above the Fed funds rate. We have a Fed funds rate now at 4.3%. So, do the math. You're talking about 5.5, 5.75 potentially on the 10-year, and that's a normal term structure. That's not anything that's unusual. And I think we got so used to this inverted curve, with the short above the long. We thought the long would stay low, but that is not normal through history. So now I think what investors have to say is, oh my goodness, all right, if the 10-year goes into the fives, earnings are going to be good, but I have to take that into account.
Are you thinking that the Fed might not cut anymore? I know you said the market might be thinking that. Does that match with your own view? And do you really think that the 10-year could get substantially over 5%?
I think it could. I think no one really, anything could happen, when we talk about 3, 6, 9, 12 months out. Clearly, if things start slipping, the Fed will lower. But given the growth that we see right now under that, and if you take a look at the futures and adjust them for risk premiums as I do, I really see that virtually every cut has really been wiped out. And looking at history, I was saying that is actually a formula for higher long-term rates. And as you know, before year end, I said that this could be the year of a correction. I don't think it's going to be a big collapse. Look at the VIX. I think crossed 20 today. It's a little bit lower now. That's a lot of hedging in the market. There's a lot of people that say, "Oh my goodness, this could be a little bit of a dip." But when you get VIX at 20, I don't see a big fall. But I think the thought that I have to deal with maybe a 5 to 5.5% long bond. How do I allocate in that case? And especially for all types of stocks. Small stocks are hurt because if the Fed doesn't cut, their interest costs remain high. The tech stocks don't borrow at those interest rates, but they have to worry about discounting. And since they're, such high PE ratios, a small change in discounting send them lower. So both those have, for different reasons, been depressed by the strong economic growth. By the way, no one mentioned today that the wages came in at or actually below expectation. So, it wasn't a wage pressure situation over here. It was really, wow, this economy moves ahead at this interest rate. Is that R star, or what we call that natural rate? It's really, we're very, very close to that now, maybe just a tiny bit restrictive, if at all.